All right, just turn off the music. I'm going to turn off the video here so we can get things going. And I will bring up the slides. Okay, welcome everybody. Really glad you could join us. We're here today to talk about Cadillac Commons. It's a mixed-use development opportunity in Austin, Texas that we are really excited about. And we hope you're as excited about it as we are by the time this presentation is done. My name is Joel Fine, and I will be one of your presenters. I'll introduce the others in a couple of minutes. We have an hour for this, so we're going to dive right in. We are recording this, and we will make the recording available after we're done. So feel free to ask questions using the Q&A button in your Zoom window. You can ask as we go along, but we'll address questions at the end. So we'll try to leave some time for the questions. First off, a legal disclaimer. I apologize for the length. I do want to point out a couple of highlights. First off, this presentation is for informational purposes only. We will be making some forward-looking statements. Those statements are projections and are not guaranteed. We believe the information we're presenting is from reliable sources, and we've made it as accurate as we know how, but we encourage you to do your own due diligence. So a summary of the project we're going to be talking about tonight. We're calling it Cadillac Commons. It's a 15-acre development project, mixed-use development in Austin, Texas, in an absolutely amazing location. And we'll talk at length about the location shortly, but first, a little bit more about the project itself. It's mixed use, a mix of residential and retail. On the residential side, we're planning a 265-unit Class A apartment complex. And on the retail side, a 43,000 square foot retail plaza. The location, as I said, is amazing. It's 5 minutes from the brand new Tesla Giga Factory in Austin, Texas, which is now also the Tesla International headquarters. Elon Musk in the past several months has projected something like 20,000 Tesla employees once the factory really gets fully spun up. And those employees need a place to live and a place to shop and eat. There's really very little multifamily or retail in the area at the moment. So it's an opportunity that we didn't want to let go. So for the purpose of this presentation, we're making available some limited partnerships for passive investors who'd like to be part of this deal. We're projecting a total return of 21% per year. That's in terms of internal rate of return for our passive investors based on our expectations of a 3.5 year hold. That's a summary. So the agenda for this meeting, we're going to talk about the background of the project. We'll introduce the team that's working on the project. We'll share more about the location and the property itself. We'll discuss the business plan, how we intend to go about doing the development and the build. We'll discuss the financials of the investment. We'll share a little bit about the risks, and then we'll explain how to go about investing. So some background. Again, we've got a real supply and demand imbalance here with Tesla and other employers coming to the area and bringing many thousands of jobs directly into this neighborhood that is otherwise relatively undeveloped. Again, Tesla's looking at many thousands of jobs, 20,000 direct jobs and up to 100,000 indirect jobs in support. And as an example of the indirect jobs that we can expect to see, Blackstone has recently announced that they are planning an industrial facility about 2 miles away from our site. There's really not a lot of competition in the area. The nearest market rate multifamily housing is more than 5 miles away. We commissioned a market study last October, about 6 months ago, and that study was done before some of these new announcements about new employers coming to the area. And even then, the market study concluded that the neighborhood had a shortage of at least 400 multifamily units coming up. And again, there's very few retail and dining options available in the neighborhood. So based on that, based on the ongoing, the prevailing rent rates and the anticipated imbalance of supply and demand, we believe that the rates for renting the apartments and for either renting or selling retail spaces are going to make for very compelling financial returns. And so that's what we'll be discussing with you today. A little bit about the team. Again, my name is Joel Fine. I'm a full-time syndicator. I've sponsored 6 value-add multifamily deals, a little bit more than 1,000 doors across Central Texas. I'm a managing partner in ground-up development projects across 157 acres, also in Central Texas. And I'm a limited partner in a large number of syndications, totaling more than 12,000 doors across, I believe it's 13 states now, and 460 acres of development. And in my background before real estate, I was an engineer, then a project manager, then an entrepreneur, then an executive. Now I'll turn it over to Anna Swanson, one of my partners, to introduce the K-Bar Group. Anna?
Thanks, Joel. Hi, everybody. Thanks for joining us here tonight. I'm Anna Swanson with the K-Bar Group. We are a third-generation land development company. We are currently managing projects all over Central Texas, from Waco to City of Lockhart. We have a deep understanding and experience in residential subdivisions. That is K-Bar's bread and butter. We have ventured off into more mixed use and multifamily projects, which is what we will speak on here tonight. I will pass it over to our partner, Travis.
Thanks, Anna. Like Anna said earlier, our family's been developing land across Texas for several generations now. My parents got us into the industry a few years ago with an initial focus on more rural projects. Recently, we've been doing more and more high density projects such as this one, which we look forward to sharing with you in a bit. But before I do that, I would like to also talk about the rest of the team that we're working with. So first off, we have the Novak brothers, which is who is acting as our general contractor. We currently have a pre-development arrangement with them. All the numbers you see today are the biggest variable in today's market is stuff like the commodities with the price of wood and everything. They've really helped us make sure that we've kept our pencil sharp on our numbers. The numbers that you're going to be looking at are going to be based off of pretty much what the market is saying as of 1 or 2 weeks ago. Next, we have Pape Dawson, our civil engineering firm. They're pretty much one of the preeminent civil engineering groups inside the Austin marketplace. While they are all across Texas, they have a deep background in the Austin market. And for those of you that are familiar with Austin, they actually designed a big chunk of the domain, which is pretty awesome. Last but not least, we have Mark Hart, architecture. Mark is an architect that's been in operation for about 1.5 decades now. He has a lot of experience working with the city of Austin on multifamily projects and student housing projects inside of the Austin core. Needless to say, what that means is we brought together the perfect team to hit the Austin marketplace and actually work with Austin's regulators to make sure that we can get a project designed effectively that people want and have it delivered on time. But let's go ahead and dig into the marketplace in general. So for those of you that Now, I don't know where you've been if you haven't heard about how hot Austin is these days, but Austin is one of the hottest marketplaces in America today. Last year, Yahoo Finance pretty much stated that Austin is the #1 opportunity for housing in terms of development opportunities across the United States. With us being not just a place where people want to go and work, with a lot of Fortune 500 companies bringing headquarters and also satellite offices into our area, but also just general demand growth for the high-tech industry in general. The most visible employer coming in is also Tesla. Joel, if you could show all the brands that are coming into the area, I think that'd be great. Now we have Google, we have Samsung, we have AMD. We're actually the headquarters for Dell. And last but not least, Tesla. On top of that, Austin's a fantastic place to live. People like to live in the Austin area. And the biggest problems with Austin is just two. There's traffic, which we can't do anything about. And there's also housing. Housing prices are skyrocketing in the area for both to own and for rent, which means that we're coming in and we're filling that hot need. And it's even more pronounced in the market that we're playing in. So on the next slide, you'll see that we have a snapshot of the neighborhood that we're inside of. The area that we're inside of is the Hornsby Bend neighborhood. It is 5 minutes from the Tesla complex. Our site is. It has several large developments that are existing. We have D.R. Horton to our west, and to the east, there are several large projects that are coming in to the area. So we pretty much have good neighbors whenever it comes to housing projects. Not only that, but from this area, we can serve people that are working throughout the Austin Metroplex, with the domain in downtown being less than a half-hour drive from our site. Additionally, we have convenient access to the airport, and for you NASCAR and F1 fans out there, CODA's super close too. These demographic numbers were pulled over half a year ago, so they've probably actually improved significantly, but this is from our market study, which is what we're basing our rents off of, which is why we're showing it to you. On a high level, the big takeaway, excuse me, is that the population in the Hornsby Bend marketplace is just skyrocketing right now, with the population projected to increase by a significant amount over the next 5 years, which is when we're anticipating to hit the market. Well, not 5 years, but I think 3.5 years from now, when we're planning on hitting the market, demand will have increased significantly. And there's not a lot of competition for apartment projects or apartment rental opportunities in the marketplace today. Also, on top of that, with Tesla coming in, as Joel mentioned earlier, Tesla inside that big green blob with our itty bitty little red blob, we have 20,000 employees that are going to be working out of that site. And those are direct employees for Tesla. That's bigger than the town I grew up in. On top of that, we have another 100,000 jobs that are going to be created by those 20,000 jobs. We're talking about service companies. We're talking about vendors that work directly for Tesla, and we're talking about all the other industries that support 20,000 people coming into that area. What that means is that there is no logistical way for the Hornsby Bend area not to boom and just get both just a lot of people wanting to live in that area, but also increased demand for the retail products that we're proposing of putting in there. So let's move on. Now let's talk about the property itself. On this property, it's 15 acres that we've assembled over the past year. Almost 10 of those acres are buildable. That actually is working out really good for us because the non-buildable acreage is relatively flat, And while it does constitute as a creek, according to Austin, it is also a fantastic place that for any type of amenity. So we're repurposing the non-buildable area into a massive, 4 to 5 acre park for our residents and for the future retail tenants. In addition to that, Weberville Road is experiencing increased traffic year over year as more developers are coming in, putting in projects to our east. And so you have people going from east to west, driving past our parcel, going into Austin to work today, and that number is only going to increase. So that's going to capture retail customers, and it is also going to attract residential users, people that want to live on that site because it's more convenient than what they have today. Let's move forward.
All right. I'm going to bring up the video and we'll test my technical skills here.
For those of you that missed the elevator music earlier, and Joel is rendering 1,000 times better now than earlier. This is the site that we have planned out. This rendering was made by Mark Hart, who has been designing it. So it's on the apartment side, it's pretty accurate in terms of what it's going to look and feel like. On the commercial side, we are still on the early stages of Cadillac Plaza's design. So expect that to shift around a significant amount as we move forward. Once again, we just soon buy the park. We have some detention areas that we're turning into a nice attractive amenity, and it is going to be a pretty fantastic project. So Joel, whenever you're ready, I would like to start digging into the details of the project. Thank you, Joel. And for some reason, it's a little pixelated. There we go. So what we're looking at right now is the site plan for the combined project. We're not very creative, so right now we're calling it Cadillac Commons. On the top side of Cadillac Drive, you see 5 multifamily apartment buildings that are 5 stories each. The middle building has the amenity center put into it. Down below, on the other side of Cadillac Drive, you see the retail product. So we have an eatery corner, a pad site for a brew pub or restaurant, bar and grill, something like that. And then to the right, we have some parking, which will serve the retail side of the project. So we have some great strip center material here for gyms, or potentially a gym, maybe a Subway. There's a lot of vendors that would be very interested in the site. And then down below, there is a huge demand for industrial clients as well as tenants. Notably, we just met with our neighbor that's to the right, and they're building a semiconductor facility over there. The company refurbishes semiconductor equipment, and they're actually pretty excited about this project because they're like, oh, our employees can, live across the street, walk to work, and then go down to the eatery and have a burger and beer, which is kind of cool. Let's look at the numbers on the apartment project real quick. So with this, we have 265 units across all 5 buildings, relatively even split of 1 versus 2 beds. That's what the market study recommended. So that's what we're going with. We have 1 parking spot per bedroom. And if you look to the left, you'll see that we have a biofiltration pond set aside. We're hoping that we can actually turn that into a neat little amenity, have a boardwalk go across it. And then as people go across, they can look to the left and see a well-sculpted, I wouldn't say garden, but naturalized area with native Texas plants that will help filter the runoff from this site. Joel, if you could show the rest of the bullet points as I go along, thank you. This is a Class A apartment complex that we're building because that's what the market wants in this area. Everything's going to be elevator served. The hallways are going to be air conditioned, and we have a huge green vibe with this apartment complex, since we have that multi-acre green space dedicated for the residents, and the ground floor units are going to be pet friendly, which allows us to charge them a little bit more on rent. And also people like their dogs, so you can expect to see a dog run in that park once we're done with it. Next, we have the detailed site plan, a zoom in of the site plan for Cadillac Plaza. This is much earlier in the design phase, but on a high level, as I said earlier, you have a restaurant on the left, and then on the right-hand side, you have a blend of retail and industrial use. And we're also expecting that there's going to be a little bit of executive office space as well on this side as well. One of the really cool things about this project in particular with Cadillac Plaza is that the biggest challenge that we were running into with the apartment project earlier is that there just isn't any walkability anywhere in the area, much less on our site. And on top of that, there weren't a lot of eateries or retail in the area earlier. This is one of the earlier sites whenever you're driving from the toll road on 969 where you can have that, where you can have a retail site reasonably, since we do have road frontage on 969. With that, what that means is that we're providing retail access, walkable retail access to our apartment residents, which ultimately is going to impact rents. And inversely, you're going to have an eatery and some retail spaces that have a captive audience because they have an apartment complex right across the street. There's a lot of synergy going on here, and I'm really excited to see the next round of numbers later on down the road once we get closer to construction. Let's keep on going. So we just did a nice overview of the site plan. Now we're going to get into the fun part, which is going to be some of the pretty pictures. So once again, these are relatively accurate or very comparable renderings from our architect team. These are actually driven from the CAD designs that we're ultimately going to be handing off to our builders. So with Cadillac Commons, you have Cadillac Apartments on the left, Cadillac Plaza on the right. Since we own both sides of the road, what that means is that we are able to control the entrance to Cadillac Drive and create a nice pocket community feel to it, which allows for us to set the tone for what type of demographic we want to attract and create something that feels niche. On the next image, we have a view of Cadillac Apartments coming in from the back. So this is going downhill towards 969 with Cadillac on the right-hand side of the road. One thing that I want you to note is that you can actually see downtown from here. Since the site is on a slight grade, which is why those buildings are at an angle, what that means is that the top two or three floors of every single building is going to have a view of downtown, which means that we'll actually be able to charge a little bit of a premium on those units because people like to have a view. So that's really cool. And it's going to make some great marketing photos too. Here's a rendering of the planned amenity area that we have. You'll see that we have big wraparound decks, nice open views, and of course a really classy pool, because what Class A apartment doesn't have a nice pool involved? You don't see the gym that we're planning, but now, thanks for jumping ahead, Joel. No, you're good. Right here, we have a patio deck on the 5th floor of the rearmost unit. I love this photo because it really helps you get an idea of what it will look like when you're living there and you see downtown. Also note that we're playing around with the idea of putting in some solar paneled carports. We're going to charge for those carports, so it will be a premium parking spot. Also, Austin Electric has a rebate program that we're currently exploring, and we want to be able to play off of the Tesla vibe since we're so close to pretty much the solar panel king of America right now. On the other side of Cadillac Drive, you have Cadillac Plaza. I've already said a lot about it, so I'll keep it straightforward. We have a really nice courtyard concept that we're playing with right now for the plaza. The goal is to pretty much create the community hub, the communal hub of the Hornsby Bend area. Also, just think, you're going to have all these Tesla employees that are getting off the clock and are going to want to have dinner, maybe have an after hour beer. Where are they going to go? We are going to be one of the closest places for those employees to go grab a bite after work. We're going to get a lot of traffic here. Also, you have some great retail opportunities as well. Several franchises would be attracted to this area. Once again, early stages, we need to get a little bit further along with the planning process before we can start getting specific clients lined up. Once again, you have the courtyard area, very high level. We're going for a Treaty Oak style vibe for anyone that's familiar with that place. And if you look right here, the reason why we included this image is just to give an idea over the scope of the green space that we're including on both sides of Cadillac Drive. We're really hoping that this will be a highly used amenity. Ideas on what we're planning on putting into this amenity space is going to be dog runs, frisbee golf, some seating areas, shaded areas, and also make sure that people have an area to do nice little walks on. And that's pretty much Cadillac Commons. That's the project that we're working on. It's pretty baked right now, and it's been a very fun project to work on. Joel, you want to take it from here and dive into the financials?
Absolutely. Thanks, Travis. So before we get into the details on the money, I want to talk a little bit about the timeline for the project. So here I've got a chart that shows the timeline at a very high level. So going from left to right, we go from the year 2022, where we are now, to 2025, where we expect to wrap up and sell the project. So line by line, we've got an indication of what activities are happening at each stage. So starting from the top, we're currently acquiring the land for the retail plaza. We expect to close on that sometime next month. So that's the land on the east side of Cadillac Drive. On the west side of Cadillac Drive, the land for the apartments, we actually already own and control that land through another syndication that we run. And the intent is that we're going to be having that syndication sell the land to this syndication at an appropriate time. And that time will likely be right around February when the project is shovel ready. So we'll continue to work on both pieces of land, both the retail plaza as well as the apartment land, in terms of the entitlement and planning and architecture. And then early next year is when we'll be ready to go on the construction. So if you continue down the rows, construction will begin in 2023. It's going to last about 18 to 20 months. That'll take us through to mid 2024, at which point we anticipate having certificates of occupancy, which allow us to begin leasing up the properties. We'll lease up over the following several months. We're anticipating about a 14 to 16 month lease up process. Once we're pretty close to stabilized, at that point, we'll explore a sale of the assets, both the retail and the apartment complex, and wrap up the project right around December of 2025. So 3.5 years from now, that's the timeline we're projecting for this project. So getting into the budget, sources and uses, I always like to start with uses because that tells us what we need in order to accomplish the project. So the uses is really the cost budget. What do we need to spend? So first, of course, we need to acquire the land. So the two pieces of land combined are about $6 million. We anticipate construction costs in the range of $53 million. The soft costs include things like civil engineering, architecture, utilities, pre-work, and so forth. We're ballparking that at $9.4 million. And then the carrying costs, meaning the cost to finance the project, the interest expense, is about $6 million. So the total for this project is just a hair under $75 million for the apartment complex and the retail combined. So how are we going to fund that budget? Well, first off, we're getting a land loan to acquire the retail side right now. And that land loan will be just a little bit over $1 million. Then later, when we're shovel ready, say in February of next year, we'll line up a construction loan. That construction loan will be roughly $58 million. That'll cover 80% of the cost of the project. In addition to that, we're raising equity. So tonight's webinar is all about stage 1 equity, the planning and entitlement money to help us acquire the land and then go through the planning and entitlement process. So we're raising $3.5 million now. And then for stage 2 of the equity acquisition, that's when after we're shovel ready and we're ready to begin construction, we'll combine that with the construction loan. So the 11.5 plus the 58.6 for the construction loan, that will cover the cost of construction. And that gets us to our total budget of $75 million. A note about the fees for this project. There will be an acquisition fee of 2% of the land cost that covers our expenses in the course of conducting the transaction. A loan guarantee fee of 1% of the loan amount that covers the risk that the signers on the loan will be taking on since they're likely to be recourse loans. And then the developer fee of 4% of the cost of development, which again covers the expenses that we incur as we manage and guide this project through to completion. Moving on to the operating pro forma. So this is, imagine we're done with the build, we've leased up, and now the project is operating at capacity or at steady state. So again, we've got 265 units total, split up about evenly between 1-bedroom and 2-bedroom units. And based on the market study that we did, our estimated monthly rents are roughly $1,500 and $2,100. That's going to vary a bit because the different 1-bedroom and 2-bedroom options come in different sizes. So we'll have larger and smaller 1-bedrooms, larger and smaller 2-bedrooms, but they'll average out to these numbers that I've got here. If we multiply that out, that works out to about $5.7 million of gross maximum potential rental income. Other income will include things like parking fees, pet rent, and so forth. We'll take out the revenue for 2 model units, since in a property this size, we're likely to need a model unit of 1-bedroom and a model unit of 2 bedrooms that we can show to potential tenants at any time. That gets us to a gross income of $5.8 million per year. We'll allow for some vacancy, which takes us down to $5.5 million. On the expense side, I'm not going to go through this line by line, but these are fairly typical numbers for a property like this. And it adds up to just over $2 million per year in expenses. So some simple math, the revenue minus expenses gets us to a net operating income of $3.5 million. So if we then take those numbers for the apartments, the 5.5 million in revenue and the 2 million in expenses, that gets us to the, again, the 3.5 million in operating income. Then over on the retail side, I'm not going to share quite as much detail on that side, but we anticipate a total net income on the retail property of just under $750,000. So if we take the 3.5 million and the $750,000 over from the net operating income on the left, add those together, that gives us a net operating income for the property of $4.2 million. Properties in Austin these days are selling at 4% or lower cap rates, which means they're selling for even better prices, higher prices than we have represented here. But we've underwritten at a 4.5% cap rate as a way to be at least a little bit conservative. And so using that cap rate gets us to a value at sale of just under $94 million. If we anticipate some costs for the sale and the cost to pay off the loan to the bank, that leaves us with $31 million to distribute back to our investors. So the way investor returns are going to work on the shares that we're making available, there will be a very, very healthy 16% preferred return. What that means is our investors will get 16% on their invested money, assuming that there's money available after expenses and debt are paid. And that comes before any profit goes to the general partners, to us. After the 16% preferred return, there's a 50-50 split between the general partners and the limited partners until the limited partners achieve a 20% internal rate of return on their money. And then after the 20% internal rate of return, that's a fairly healthy, substantial return, but we're still offering a profit sharing component even beyond that. So one thing I want to emphasize is that this is a development deal. So unlike, say, a value add multifamily deal, there's no ongoing cash flow. We don't have tenants on site. We don't have rental income coming in until construction is complete and until lease up is well underway. So the way we've underwritten this is largely back-end driven. The preferred return, the 16%, will accumulate. So the project will owe it to our limited partners, even as it is unable to pay it because there's no cash flow. But that return will accumulate and will be paid out in arrears. Will be paid when the cash flow will support that preferred return. So the total that we would be paying out at the end of the 3.5 years on a $50,000 investment, our projections show just under $97,000 in payout, which works out to an equity multiple just under 2. So almost doubling your money. And that also translates into an internal rate of return of 21%. So a very healthy return. So we wanted to do some what's called sensitivity analysis, which is to get a read on, hey, here's the nominal numbers, here's the pro forma, but what happens if things are a little bit different? So we varied a couple of parameters. One was the cap rate when we sell. So that center number there that's in a little bit darker font, that's the 4.5% cap rate that we've underwritten the project to. And the internal rate of return is, it rounds to 21%, but it's 20.8%. And the equity multiple I just told you about, 1.94. And you can see that as the cap rate varies, the return and the equity multiple go up and down. So when we're ready to sell in 3.5 years, cap rates are about where they are today in Austin, say 4% or even better, then the return and the equity multiple will be even better than we're projecting. On the other hand, if things happen with the economy that we hope don't happen, or if the influx of people to Austin slows down, then we could see higher cap rates, and you can get a sense of what the returns look like as the cap rates rise. 5% we think is a very conservative number. We think we're fairly unlikely to hit a number that high, but even if we do, that preferred return really protects our limited partners, and we're still able to deliver a very solid 16% return on the money. We also wanted to see what would happen if the construction timeline varied from the base case that we're underwriting. So again, that base case is 3.5 years. If somehow we can accelerate that, then the internal rate of return for our investors goes up a little bit. If it takes us longer to finish construction than we anticipate, say another 6 months, so it becomes a 4-year project instead of 3.5, then the internal rate of return drops a little bit. You'll note that it doesn't drop very much. So that tells me that we're not that sensitive to the construction timeline, at least on this scale. We can afford a 6-month slip without a lot of impact. So the cap rate in the previous chart clearly has a much bigger impact on the returns than the construction timeline. So going through some of the risks that we're tracking, and these risks are not particularly unusual. These risks apply pretty much to any development project that you might look at. So first one, entitlement, getting permits, getting approvals to build. We're in Travis County. We're not quite in the city of Austin, in the city limits, but we are affected by Austin. We do have to get approval from Austin for certain things. And both the city of Austin and Travis County are notoriously slow, and they're fairly backed up because of the influx of people and the very high demand. There's a lot of development going on across the city and county. Good news here is we're in the ETJ, that stands for extraterritorial jurisdiction. That's a ring around the city of Austin where some of Austin's ordinances apply, but many do not. And in particular, the zoning restrictions that Austin imposes on its own city, within its city limits, don't apply. So, so there's a lot of flexibility and acceleration that can take place in the process as a result. And also we're well underway on the apartment site plan that's already in review with the city. Another risk is the timeline. Everybody's heard at length about the issues with the supply chain, and we have no illusions that that could affect us as much as anybody else. We're going to need wood and metal and wiring and drywall and everything else that goes into a construction project, just like everybody else. And so if those issues occur, then you know, that could impact our timeline. So as I said earlier, though, we've got some wiggle room there. Even if the construction takes us 6 months longer than we anticipate, our returns really aren't affected that much. Along with the supply chain issues, we've got concerns about inflation. Again, I'm sure everybody's heard at length about that. Prices could go up relative to what we've underwritten. We have built in some inflation already in our numbers, but it could be worse than we expect. So we do have some contingency in the budget. The other thing that will tend to mitigate this is that rents also tend to move upward in a high inflationary environment. So we're trying very hard not to count on that. But if inflation really hits a gallop, I would expect that not only the cost of raw materials, but also the rents that we can charge tenants will rise. So on the revenue side, we may have a little bit more room to play with. Utilities are always a challenge for a site like this. Water is already on site, but we need higher capacity than is there. And we need to bring sewer in. So we're already working closely with utilities to make sure that those are on hand. We have verbal commitments from the utilities. They've told us verbally that they'll be on site on time. And now we're working to get them to put that in writing. Another risk, debt. We don't yet have debt lined up because we're not close to shovel ready. Folks who do construction loans like to see projects much closer to shovel ready before they actually lock down on terms and prepare to issue the loan. So we'll line that up in January. We're fairly confident that we'll be able to acquire debt and at reasonable terms. We've talked to probably half a dozen or more lenders, and every one of them is very interested in participating in this project. They know just as we do that what kind of potential it has. And then real estate values and cap rates. With the US economy potentially hitting snags, that could have a negative impact on property values. But again, the mitigation here is that there continues to be a strong inflow of people into Austin, an imbalance of supply and demand, which should tend to prop up property prices. So getting into the investment structure, what we're doing now is we're creating a syndication, an LLC, which will own the land and run the project. And what we're doing with this presentation is we're offering limited partnership shares in the syndication. Right now, we're raising $3.5 million for land acquisition, planning, and entitlement. And then the subsequent raise in around January of next year will pay for the construction. We anticipate that raise to be roughly $11.5 million, but it'll depend on the kind of terms we can get on the debt. I will say that early investors, those who invest in this $3.5 million round, will get more favorable terms on their investment than the folks who are in the raise in January of 23. And that's because, number one, they're in it for longer, and number two, they're taking a little bit more risk in terms of the entitlement. Once we get to shovel-ready state and we start that second round of raise, many of the risks that we're facing now will have been resolved one way or the other. Our minimum investment level is $50,000. And this particular syndication is being filed under a 506C exemption for the SEC. So what that means is we're restricted to accredited investors. So all of our investors will need to be accredited. That's not as complicated as it sounds. It's not like you have to take a test or get a license. All that really means is you have to have certain financial means at your disposal. And I've listed the two key financial metrics that apply to accredited investors, and it's one or the other. So either your annual income is $200,000 as an individual, or $300,000 when combined with a spouse, or a net worth of $1 million or more. any of those three, if you can check that box, you're accredited. As far as the investment process itself, again, the minimum investment is $50,000. We are accepting self-directed IRA or solo 401k funds, but I would encourage you, if you're planning to use funds from one of those types of entities, plan out the time that you need to free up the money, especially if you don't yet have your self-directed IRA opened. That in itself can take a week or two, and then from there to funding it and then getting your custodian to approve the investment can take time. So anticipate the time that it will take and prepare for that so that we have enough time to fund this deal. As far as the process and the timeline, today, May 11th, we're doing the presentation. We're looking for soft commits early next week. The following week, we're looking for signed investor documents. And then a few days after that, we would like to have funds in hand. We've got a lot of interest in this offering. We anticipate that it will very likely oversubscribe. So we encourage you to submit your soft commit early and sign your documents quickly when they become available. I've got the link up here and I'll send it out in email to folks who are attending. If you're interested, first step, like I said, is to do a soft commit. A soft commit is kind of a misnomer. It's not actually a commit of any sort. It's really just an indication of interest. So it lets us know, yeah, you like the deal, you're thinking about it, and you put a number on it, 50,000, 100,000, whatever amount you're thinking about investing. So go to this website, and that will allow you to take that first step towards an investment. The investor portal where you'll make that soft commit looks like this. So just wanted to flash that screen so you can see what the website will look like, so you'll know you're on the right spot when you get there. And what we'll want you to do is when you're ready to move forward, you'll click the orange Invest Now button up here in the upper right. So to recap the information we've shared with you, this is a 15-acre mixed-use development project in Austin, Texas, in a phenomenal location. On those 15 acres, we're planning to build a 265-unit Class A apartment complex, a 43,000 square foot retail plaza, and this location is very, very close to the Tesla Giga Factory and Tesla's international headquarters, which means there is going to be a tremendous swell of demand from not only Tesla employees, but other folks employed in the area, with very few housing options available to them very close by. So we're offering up limited partnerships for passive investors, and we anticipate a 21% annualized return for our passive investors over the course of this 3.5-year hold. With that, I'm going to turn it over to Anna to moderate our questions. So again, please type your questions into the Q&A box, and that way we can go through them one at a time and try to make sure we address them all before we run out of time for the session.
The first question is there a way to get a copy of this deck after the call?
Yeah, what I'll do is I'll post the deck to a publicly available Google Drive folder, and then I will send that location out to everyone who's registered for the webinar.
The next question is referring to the apartment complex. Why only 1 and 2 bedrooms when most families have at least 1 child or more? Are you marketing for single families only?
I can talk to this one. So we're basing our unit mix off of the market statistics in the area of what's out there right now and the type of audience that we're targeting. For this one, the 1 to 2 beds is targeting either singles or potentially couples that only need 1 bedroom for themselves. So think young professional. And then the 2 beds are geared more towards maybe a couple that needs some extra space, an individual that wants a private office, or a small family that has one kid, maybe two kids, that are bunking up in the same room. That's just the market for this area. On top of that, there's a lot more, it's a lot more profitable to have 1 to 2 beds because we can charge a lot more effective rentable square foot.
I would also add that there just isn't that much demand for 3-bed apartments. So yeah, like Travis said, we want to maximize our per square foot revenue yield, and the best way to do that is with 1 and 2 bedroom apartments.
Yeah.
Since this offering is for accredited investors only, would you consider having a group of investors with a combined income of 300K plus?
I'm not sure that is going to pass legal muster, but I would have to check with my attorney. So what I would say is, for whoever asked that question, please reach out to me offline and let's have a conversation to see if we can make something work.
How will you handle investors who do not participate in the next raise or participate at less than proportionally required?
So that, I think this question makes an assumption that isn't valid. Let me clarify. The next raise is not going to be a capital call of the people who fund the deal now. It's going to be additional shares that we're selling to either new investors or existing investors who would like to invest more. But it's not a capital call. We're not going to instruct you to fund additional money. It's going to be just a brand new offering, but in the same entity. So it will be different terms for the shares that we sell in January, but it will be new shares that we're selling, not capital call on existing shares.
Can you explain the assumptions used in the expected rents when construction is complete?
Say that, ask that again. I feel like that was a me question.
Can you explain the assumptions used when anticipating expected rent prices when after construction is complete?
Got it. Yeah. So for our current numbers, what we're doing right now is we're assuming that rents are not going to increase from the market study all the way up until Joel, I don't remember, did we do 6 months or a year prior to completion? We start reflecting some appreciation in rental rates. I think it's 6 months is what we went with. We'll start reflecting rental appreciation prior to lease up start. And then the lease up rates we're using is about, sorry, not lease up rates, the appreciation we're projecting is 3%, which is actually pretty conservative for the Austin market.
Yeah, let me take a piece of that, backing up a step. So when we commissioned the market study for this property, one of the things the market study came back with was an expected rent rate. And they gave us numbers for different configurations of 1 and 2 bedroom apartments. It averaged out to $1.90 per square foot. And so we used the numbers that the folks who did the market study gave us. Their market study covered rents in the area. As I said earlier, there's not much competition nearby, so they had to go a few miles away. But then they took the numbers from existing properties that were of similar finish outs, also Class A, and then applied a correction factor for either location advantage or disadvantage. And that's how they came up with the $1.90 per square foot. And that's ultimately what we end up using in our spreadsheets.
And I have a correction to make over what I said earlier. So based off of the Austin's market, including this market study, we're assuming a 3% increase in market rents year over year. We're not starting that increase until a year prior to construction completion. And right now in our numbers, we're projecting 18 months of construction. So in other words, you're going to have about a year to a year and a half where any appreciation in rents is not going to be reflected in the numbers that we looked at today. Try and be conservative.
The next question refers to the developer fee. How will the 4% developer fee be paid out? Not upfront, I'm assuming.
Right, we're paying it out through the life of the project, spread out all the way up until the end of construction. And we're going to be spacing it largely by milestone. We're going to throttle it until we get to shovel ready, and then it'll increase during construction because our overhead will increase significantly at that point.
Do we need to have a third party verify if we are accredited? If so, which one?
Yes, we will line that up. I believe it's going to be, there's a couple of them, and I'll have to email that out because I don't remember the names offhand. But there's two that we're anticipating using that are pretty well known in the industry. Excuse me.
The next question refers to the construction portion of this project. What method of construction will be used? Will there be a full concrete pour, or will you be using lumber?
So the construction is going to, I mean, we're using concrete for the slab, of course. The site is on a grade. So it's some of the slabs are actually going to be split. So that's actually going to be 5 stories on one side, 4 stories on the other. For the actual vertical piece, that's going to be lumber. We looked at steel, and it just doesn't make sense to move to steel right now. There's a little bit more stability in steel, but I think there was a spike earlier this year, and so lumber just seems like the most conservative choice for us.
Is there an HEB going up in the area?
Not that we know of. We know that there's a huge demand for more grocers. I would be shocked if an HEB did not pop up in the vicinity sometime in the near future. That said, I think the nearest HEB is like a 12 or 15-minute drive away. So there is access to a quality HEB. There's also a few local grocers that are like a 2-minute drive away that can act as a stopgap until a more robust grocer comes into the area.
The next question is referring to what the deal will be valued at when in a shovel-ready state versus what the deal is valued at today.
Yeah, I'm looking at that question. I think it has more to do with what kind of returns can investors expect if they invest in the stage 2 funding. And that's a little bit hard to answer. We'll know more as we get closer to that. But the terms we'll be offering, as I said, they're better now than they will be. I'm guessing that we're going to be in the range of 18 to 19% internal rate of return. And then, of course, plus or minus, depending on what risks we trigger and whether we're able to accelerate. So hard to say for sure, but I'd aim at 18 to 19%.
The next question is the average salary of a Tesla employee.
I actually don't know that. I can Google it real quick.
Yeah, not sure.
Yeah. The zipper glass door set. Oh, that's an engineer. That's not good. You know what? We'll have to get back on that one. We'll have to do a little bit of research. We don't have that on hand. I do know that it's probably going to be like a 90-10 split between the main workforce of factory workers and the office workers. So you're going to have a blend of high income earners and solid hot on the high end of blue collar workers in terms of income.
The next question is aimed towards how the debt is structured, if it would be an interest-only loan for the entire project.
Right now we have term sheets from banks that are interest only that we really like. And so one of those is what we're using for the numbers you're looking at. In that particular one, it is interest only through the entire life of the project, all the way to the sale of the apartment complex.
And can you anticipate expecting cash flow in the year 2024?
I'd have to look at the spreadsheet. Joel, do you have that handy?
Not handy, but I would say it's more likely that cash flow is going to start in 2025. The reason is that we'll be beginning the lease up early in or mid 24, and until we're well into lease up, we're really not going to have much cash flow. Whatever units we lease are just going to cover expenses until we really get the ball rolling. So I would expect 2025 would be the first time we'd see significant cash flow.
Yeah, I'm looking at the numbers right now, and cash flow after financing is going to be this on this spreadsheet that I'm looking at. It's going to be over $600,000 a year cash flow for the project after paying for debt service. That's not really reflective over what the asset cash flow would be if on a holding strategy, however. Because
so Travis, this question is specifically around 2024 versus 2025.
Okay. Yeah, and also as an investor, don't expect any payouts until reversion, the sale of the apartment complex to whoever wants to hold it forever.
The next question is, are the existing investors in your other syndication getting a similar offering to invest in this one or at more favorable terms? Would you care to divulge those terms so we can see how beneficial it would be for an investor to invest in this round or towards the next round?
So other syndications we're running are 506Bs, which means we don't have permission from the SEC to talk about them with folks that we don't have individual relationships with. This is a 506C, so we've cast the net wider. My expectation is that there are people on this call that we don't have relationships with, so we wouldn't be able to comment on our other deals in this forum.
Joel, do you think we'd be allowed to talk about this round versus next round in terms of what we're thinking about, or do you think that would be premature?
Well, we already answered that question.
Oh, okay. Never mind then.
Will there be depreciation that passes through to the LPs, and can we assume we'd be receiving K1s for tax documentation?
So there will likely be no depreciation, maybe a very minimal amount, because we're buying something that's essentially bare dirt. That's not strictly true. The apartment land has a house on it that we'll be knocking down, but that house has minimal value. So if there's any depreciation, it will be de minimis. Then following that, on the K1 side, we are going to incur expenses. And those expenses we should be able to pass through to our investors. So we would anticipate providing K1s in which you could show the loss for the expenses incurred in the early construction activities.
How does this project differ against the Grove at Mustang Ridge from an investment perspective?
So again, that's a deal that we really can't talk about because that's a 506B. So whoever asked that question, and if you want to reach out directly to me, I'm happy to chat with you offline, but I can't discuss it in this forum.
Interest rates are going up. I assume that's been taken into account in the projections.
Travis, do you want to take that one?
Yeah, I'm for some reason that question went in one ear and out the other. Could you please repeat that, Anna?
Yeah, so this takes into account interest rates are on the rise.
Yeah.
This individual is asking that if because of these rising interest rates, that has been taken into account on our projections in our underwriting.
Yeah, it has. The term sheets that we've received to date were made respective over the understanding that the bank would be issuing the loan at a later date. In other words, like, next February, pretty much when we're ready to go into construction mode. So that's kind of baked into our numbers now. That said, talking with bankers, it's still a toss-up whether interest rates might continue to go up or if they'll stabilize or go down. So, yeah.
This question has now been asked twice, so I do want to just bring it up. What is the status on the Velocity development next door?
I can talk on that a little bit. So the velocity development is coming in. I haven't seen any permits come through on it. I have seen them make a lot of announcements on their website. That said, I think the velocity development should actually synergize really well with our project, because not everyone's going to want to live in an area like that. And that area is also going to attract a very different demographic from what we're going for with a mixed use versus the targeted market that we're going after with just the Hornsby Bend area.
And this is one of the last questions that we have time for today. Have construction bids already been received, or when do you expect to start receiving bids in the timeline?
We're going to be getting hard bids once we have the site plan, once we have the construction docs complete. Construction docs won't be complete until November at the very, very earliest. And then after that, we might actually hold off a little bit for an extra month or so to get closer to the shovel ready date, because the subcontractors that are going to be working with our GC, they're liking to be closer and closer to shovel ready when they issue a bid.
But I will say that the GC that we've lined up, Novak Construction, has participated at length in the discussions, and they've provided us, I guess, a cost estimate that's fairly detailed, line by line, on a lot of items based on the site plan that we've put together. So definitely not at the level of precision and confidence as a hard bid, but much better than just making up numbers. We're getting some pretty solid numbers from the GC.
And every time we've gotten fresh numbers from the Novak brothers, they actually reach out to their subcontractors and look at the actual commodities market to make sure that the numbers they're getting are reflective of that day in the marketplace, which is a pretty big deal for us since that matters a lot.
Perfect. Well, we are past time, so I'm going to pass it over to Joel to conclude today's presentation.
All right, so I just want to thank everybody for joining in. I apologize that we weren't able to get to every question. If yours was one of the ones that we didn't get to, please feel free to reach out to me or Travis or Anna, and we'll try to address your question. Again, we're going to make a recording of this session available, and we will send it out to people. We will also make a copy of the slides available and send that out to all of our registered attendees. So thank you very much for attending our webinar, and we look forward to partnering with you on this exciting project.